Banks might dodge hefty tax hikes in Rachel Reeves's upcoming budget, but is this a smart move for Britain's economy? Imagine waking up to news that could reshape how big corporations contribute to the public coffers, especially in a time when every penny counts for funding essential services. That's the buzz surrounding the UK's banking sector right now, as Chancellor Rachel Reeves reportedly opts against slapping extra taxes on lenders, sparking both relief and debate. But here's where it gets controversial: is this decision fair, or is it letting banks off the hook while everyday taxpayers foot the bill? Stick around, because we're diving into the details, and trust me, there's more nuance than you might think. Reports indicate that Reeves has chosen to steer clear of increasing taxes on banks in her budget slated for this month, a choice that sent UK bank stocks soaring on Thursday. For instance, shares in high street giant NatWest jumped by 2.5%, while competitor Lloyds climbed 2.3%, making them standout performers on London's FTSE 100 index. This uplift follows earlier worries that banks might face a financial hit. According to sources like the Financial Times, Reeves shared with her team that she won't pursue additional levies on the UK banking industry. Her reasoning: keeping banks competitive is key to fostering economic growth. To put it simply, banks are major players in lending money for businesses and homes, and taxing them more could make the UK less attractive for global finance compared to places like the US or Europe. Right now, banks operate under a corporation tax rate of 28%, which breaks down to the standard 25% plus an extra 3% surcharge. Think of it as a little bonus fee on top of their profits. This setup ensures they contribute to government funds, but some argue it's not enough. Fresh demands for what could be described as a tax raid on lenders emerged in August from a think tank called the Institute for Public Policy Research. Their research suggested introducing a new tax on major banks could generate up to £8 billion in revenue. Why? To recapture the unexpected gains, or windfalls, that banks enjoyed thanks to a special emergency measure called quantitative easing, QE. If you're new to this, QE is like the Bank of England printing extra money to buy up assets during tough times, which helped stabilize the economy after the 2008 financial crisis but also boosted bank profits at a time when others struggled. It's a bit like giving banks a financial lifeboat. Now, should they pay back some of that support? This potential bank tax isn't flying solo, it's part of a broader conversation about filling government budget gaps. Other ideas on the table include hikes on property taxes or landlords' rental income, as Reeves hunts for ways to balance the books. Ministers even had Treasury experts probe into how profitable the UK's biggest banks have become, partly due to those QE effects. And this isn't just talk. Speculation about a windfall tax last month triggered a panic sell-off in banking shares, pushing industry groups to lobby hard against it. Speaking of the industry, the banking body UK Finance released a report in October claiming that UK banks already shoulder a heavier tax burden than peers in financial hubs like New York, Dublin, Frankfurt, and Amsterdam. This is largely because of tweaks to employers' national insurance contributions starting this April. To back that up, a study by PwC estimates the banking sector's total tax contribution for the most recent financial year reached £43.3 billion, which is a whopping 4.3% of all UK government tax receipts. That's a significant rise, up by a third from £33.4 billion back in 2014, showing how banks have ramped up their fiscal role over the years. And this is the part most people miss: while banks pay a lot, critics say it still pales compared to the public mood for fairness, especially post-crisis. Not surprisingly, bank leaders are voicing their concerns. Take NatWest Group's chief executive, Paul Thwaite, who recently cautioned the government against upping taxes. With NatWest reporting a 30% profit surge, Thwaite emphasized understanding the difficult choices Reeves faces but urged a balance between fiscal responsibility and growth-supporting policies. He pointed out that higher taxes could scare off international investors eyeing the UK as a stable place to do business. Adding fuel to the fire, equity analyst Gary Greenwood from Shore Capital suggested a trade-off: if banks avoid extra taxes, they should commit to accelerating economic support, rather than just pocketing gains from higher interest rates through dividends and share buybacks. Imagine banks as engines of the economy. Should they rev up for everyone, or just their shareholders? But wait, here's the real kicker: is Reeves's stance a win for economic stability, or a missed chance to address inequality? On one hand, sparing banks might keep the financial sector thriving, attracting jobs and investment. On the other, with calls for recouping QE windfalls, it raises questions about whether banks are truly too big to tax, or if society's biggest players should contribute more in tough times. What do you think? Should banks pay back those crisis-era boosts, or risk losing competitiveness? Drop your thoughts in the comments below. Let's discuss if this budget choice is fair play or a controversial cop-out.